All right, then the next part is the introduction to deferred taxes. So we need to do what? We need to understand the key definitions. We need to understand the statement of financial position approach and how deferred taxes is calculated for assets and liabilities. And the exemption will then be covered in the next section. But that is deferred taxes. So first of all, deferred taxes, what is it? As the name suggests, these are taxes that have been deferred into the future. So you defer something into the future. So like right now, you can say, I'm not studying, I'm deferring my studies to the future, meaning that there is going to be a realization of this, but it's just going to happen in the future. So the way that it works is that you are saying that you have recognized assets and liabilities, and they will have tax consequences in the future. Those tax consequences could be that there's wear and tear on them, that when you consume it, SARS gives you an allowance or a deduction, whatever it could be. We are saying that as long as there are amounts recognized in your statement of SFP and there are future tax consequences, we want to recognize those tax consequences now. And the idea is that the tax consequences that we want to recognize are based on the Income Tax Act. So the Act is the one that governs what we are thinking. So there is a bit of movement away from IFRS. But the IFRS part comes in terms of guiding us on how to do deferred taxes. So as much as deferred taxes consider the Income Tax Act, it is not a concept in the Income Tax Act. If you go to the Income Tax Act, you will not find any mention of deferred taxes. So it is deferred taxes are based on IFRS, specifically IS 12. And it gives us guidance that we need to determine the taxes that are deferred, meaning that someone can be able to see that as much as there is this income, its tax effects are only going to come at a later point. So that's why you don't have the tax effects right now, because there is some of it that has been deferred. So it could be that we are deferring liability or tax liabilities, or it could be that we are deferring tax savings. So these savings will only be realized in future for one reason or the other. The reason that one will then be saying that, why are you not recognizing it now? That's because the way that SARS think about taxing amounts is a bit different from how accounting thinks like it. From an accounting perspective, we've got what we call the accrual system. And the accrual system says that you will include in income revenues when they are earned and not when they are what? When they are received. And it will then say that for expenses, you will deduct them when they're incurred rather than when they are what? Rather than when they are paid. However, from a tax perspective, tax will say you get a deduction on the earlier of payment or invoice. So that means they could potentially be an expense that will only be deducted in the future, or that will have been already deducted right now. And from a revenue perspective, it's also possible that we can have amounts that are going to be included in accounting at a later point. But for tax, they've already been included. Why? Because tax works on the principle of the earlier of the receipt or delivery or performing will trigger what? Will trigger the recognition of income. Okay, so those are some of the key consideration. So because of all these differences, sometimes it could be how they depreciate asset. You will want to depreciate asset and says there are no depreciation allowance here. Or you might want to depreciate an asset and SARS says, I don't agree with your useful life. This is the one that I want to use when I give you allowances. So because of those difference and the need to apply the income tax correctly, we then introduce what we will call a statement of financial position for SARS, where they will then have assets based on how much they can tax from those assets, whether it's deduction or the inclusion thereof. And this brings us to the two elements or a important definition, which is a tax base. So a tax base is a carrying amount for tax purposes. Simply said, it's a what? It's a carrying amount for tax purposes. So you need to imagine with me that SARS also transact as you transact. When you buy an asset, SARS will say, I've bought an asset as well. And I'm not going to give you any allowance because it's what? Because it's capital in nature. You'll say, sure, I agree. I have to capitalize it, and rather than consume it immediately, depreciate it over time. So that is something that we need to be mindful of. So then the tax base will then be for an asset, the amount of the carrying amount that SARS sees for that what? For that asset. And the amount that they will see will therefore be the cost minus what? Minus the allowances that they will have already given you to date. For accounting, it will be the cost minus the depreciation charge up to that point. So that those are the two things that we can agree on. And if you think about it, when you've got an asset sitting at future allowances, it means that the value of that asset or the carrying amount of the tax base, let's call it properly, the tax base of that asset represents future deductions. Because if it's a PPE, it will then have what? It will then have future wear and tear allowances. So if I say it's 100 rand, it means that I'm expecting from SARS allowances equal to what? Equal to 100 rands, but over time. So then looking at the definition in the standard, it says that a tax base of an asset or a liability is the amount attributed to that asset or a liability for tax purposes. This is the carrying amount in the financial records of the company prepared by SARS. So we've touched on that. And when we zoom into a liability, the tax base of an asset, it is the amount that will be deductible for tax purposes against any taxable economic benefit that will flow to an entity when it recovers that asset. So when we generate revenue, from a machine we bought, SARS will say that machine, I'll give you, say, 12C allowances. And you'll then need to deduct those from revenue as and when you are using the machine. So the current tax base of an asset represents the future. The future what? It represents the future deductions that you will get against that revenue. So if you then get them this year, you will agree that the tax base will go down, because it means that you are expecting to just get what? To just get a balance that is remaining. So that is how you think about it. But you might be thinking that I see this logic working for PPE. Okay, that's good. I see this logic applying for inventory. That's good. But I don't see it applying for accounts receivable. Because for accounts receivable, I'm seeing that in future, when I get the payment, I will not be allowed to deduct anything from that payment. The amount should ideally be what? Be included in income tax and tax in full. However, if you remember what we said, such taxes at the early of receipt of invoice or what? Or receipt. In this case, the accounts receivable, we have already received the money. So therefore, that amount is what is taxed. And when we receive it, there are no future economic benefits. So because there are no future economic benefits, there should not be any deduction in future in relation to those future economic benefits. So as a result, we then say that the tax base of such an asset is equal to its carrying amount. So the tax base of an asset is equal to what? To its carrying amount. When does that apply? It applies if the future economic benefits will not be taxed. So there is no need to worry about what? There is no need to worry about an amount going to be taxed. So if we are not worried about an amount going to be taxed, there should not be a deduction as well. And what should then be the tax base? The tax base will then be equal to the carrying amount. So it's just to make sure that nothing gets taxed. Because if we got a receivable of 100,000, then when you receive it, what this is then saying, it is saying that you will not receive any deduction. So as a result, then the tax base should just be equal to carrying amount of the asset. So if you then think about it, we are essentially saying that the tax base of an asset is the carrying amount of that asset for tax purposes. The last note is that our focus is on the statement of financial position, the assets and liabilities. And what we are saying is that when we use that technique of saying which assets are there, then we are applying what we call the statement of financial position approach. We're going to explore it a bit more, but for now, just understand how it works. Then a few examples to just entrench some of the things we've spoken about. So again, what should you not do? You should not do this before attempting or listening before attempting. So let's read. We are told that on 1 Jan 2020, A Limited acquired a new machine at a cost of 100,000. The useful life of the machine is 5 years. The machine is a qualifying asset in terms of 12C, meaning that it gets 40% deduction of the cost in the first year, 20% in the next year, and so on. Credit sales during the year amount to 400,000, of which 2.8 was received during the year. The closing balance is therefore 120. Prepaid rental amounted to 20,000 at the end of the year. So let's apply the definitions that we discussed in order to respond to it right here. All right, so let's see what we have in this little example right here. So we are told that on 1 Jan 2020, they acquired an asset and also there's a credit sales, prepaid rental. So let's apply. So let me open my workbook again. So this is, actually that's 0. tax base asset. Okay. So what do we have here? So we are saying, what is the tax base under each? So if we start with a new machine, what is it that we expect to receive as a deduction in the future? Do you agree on 1 Jan 2020 that what you are expecting to receive are deductions that are equal to the cost of the asset? So it means that the entire amount will be the tax base. And because each and every year I get a portion, so where in term, in the first year I get 40%, it means that at the end of the year, the tax base will then be lower and sitting at what? At 60,000, representing that in future, I'm going to get what? I'm going to get deduction worth 60. Then in year 2, I'm going to get, in year 2, I get just 20%. Then in year 3, I get what? I get 20%. And in year 4, I get what? I get 20%, which then gives me a total of 100,000. Meaning that after I've gotten all these deductions, I no longer expect future deductions. And that's why the carrying amount, so the tax base of this asset is 0. So tax base represents the amount that will be allowed as a deduction. And in this case, 100,000, 60,000, and so on are allowed as deductions at different points in time. But notice that the focus is what? The future. Then the next one says the credit sales. So when it comes to the credit sales, we are told that there is an amount of what? There is an amount of sales of 400,000. So do you agree that when the sales were made, they were on credit? So do you agree that in this particular case, we will then say an invoice is issued? So if an invoice is issued, it therefore means that a sale was recorded for tax and accounting purposes. And there will be a balance of accounts receivable of what? Of 400,000. And we are told that an amount was received, and this amount was 280,000, meaning that at the end of the year, we've got, from an accounting perspective, what do we have? We've got a receivable of 120. Now the question is, what is the tax base? So this is the carrying amount. What is the tax base of this? Are there any future deductions that we expect when we realize the 120 in the future? No, there isn't. However, are the benefits that will arise when we realize this asset going to be what? Going to be taxed? No, they are not. So as a result, the tax base of this asset will be equal to its carrying amount. So just to go through that again. So step 1, you will ask, I've got an asset which represent future economic benefits. You remember the definition of an asset? It says what? It says the definition of an asset. It says that it's a resource controlled by an entity as a result of past event, and we expect to generate future economic benefits. And we know that that amount that has been recognized, it represents future economic benefits to be realized. And now the future economic benefits of a receivable will be the cash that you expect to generate when someone pays you. And now the question is that when you get paid that 120, are you going to be entitled to any deduction? And we know that no, SARS will not give you a deduction. But will SARS tax that amount to begin with? Then no, SARS will not tax that amount. So there is actually a two test. So one is that, is there a deduction when I realize that amount? Okay. And in this case, the answer is what? It is no. Then I check, are the economic benefits related to this asset taxable? No, they are not. So therefore, the tax base is equal to what? The tax base is equal to the carrying amount of the asset. So that is what we are asking in this case. Okay. So now, if we then go to the last one is a prepaid rental. So prepaid rental, what do we have from an accounting perspective? We will then be thinking that there is a prepaid asset and a credit to what? And a credit to bank. So now the question is, with this prepaid asset, what will be its tax base? So we know that it's 20,000, but SARS will say that, have I taxed it or have I allowed it as a deduction? We know that you SARS allow on earlier of payment or what? Or invoice. Has there been a payment? Yes. So that means the deduction will be now. They will have given you the deduction now. So as a result, what do we have? We've got a carrying amount of 20,000, but is there a deduction in the future? Is there a deduction in the future? No, there isn't. Why? Because the deduction has already been received. Does that make sense? So it's not like accounts receivable. When it comes to accounts receivable, there was no deduction now, and there is no deduction in the future. But when it came to the prepaid, there is a deduction now and resulting in no deduction in the future. So as a result, it means that the answers that we're looking for is that in this case, we have what? We have the following carrying amounts, tax basis. And the last one is a tax base of what? Of 0. So does that make sense? Does that make sense on how we deal with it? So in an exam or whatever asset they may give you, apply the test. And we will notice that the test, when this relates to what? When this relates to an asset related to income, it seems to be different to an asset related to an expense. So what do I mean? Prepaid expense, in this case, prepaid rental. We focused on the question of whether the deduction has been received or not. Whereas when we were dealing with income or assets related to income, we focused on what? On whether there is going to be a deduction and whether that amount will be taxable in the future. So be mindful of how we are dealing with it. So that is what example L1.1 needed to deal with. Okay, so allow us to build this together, because by the time we get through the last example, I'll want you to be what? To be friends with it. Then, how about a tax base for a liability? A tax base for a liability is its carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. Okay, so a tax base of a liability it is the carrying amount of that liability less amounts that are deductible in the future. So it is different from an asset. An asset was simply the amount deductible in future. Here, it is the carrying amount minus future deductions. And that is when we are talking about an expense or a cost-based liability. How will an income or revenue-based liability look like? So the tax base of income received in advance is its carrying amount less any amount that will not be taxable in the future. So let us apply this. So consider these two examples, or three actually. We are saying that we've got a trade payable arising from purchases of inventory, which amounted to what? To 25,000. Then we've got a customer that paid 15,000 for goods that will be delivered only next year. Accrued rental, meaning that it's rental where we have consumed the benefits of occupation, but we have not yet paid. How will this then look like when we are determining our what? When we are determining the tax basis. So when we are determining the tax basis. So let's go for it. So the first one is the trade payable. So is the trade payable. So the trade payable, we bought inventory. So there was debit inventory, SFP, credit what? Trade payables. So that is how this was recorded. Then now we are sitting with a balance of 25,000. And the question that we have with this is that, is this a liability? Yes. What is the tax base of a liability? The tax base of a liability, it is the carrying amount of the liability, 25,000, minus future deductions. So what will then be allowed as a future deduction? What will then be allowed as a future deduction? So what will be allowed as a future deduction will then be what? Will then be zero, right? So will then be zero. So because if we think about it, when we got the invoice, we then had a situation of what? We then had a situation where we were allowed to deduct the amount paid. So as a result, it means that there are no future deductions, and therefore we have it as zero, meaning that the tax base of this trade payable is 25,000 minus zero, which is 25,000. And as a result, we've got a carrying amount of 25 and a tax base of 25. Do you see how that works? So just to quickly recap, we have got what? We have paid for inventory. We then, or not paid, but we got an invoice for the inventory. And we then were allowed to say earlier of invoice or payment. But because there is a liability, it means it's a liability acknowledged by an invoice. Then what is its carrying amount? It is 25,000. Are there any future deductions? No future deductions. Why not? Because deduction already received. Oh, I see. So as a result, what does it mean? It means that the tax base is 25,000 and the carrying amount and the tax base are equal. Now, what about that income received in advance? Let's see. So when we had the income received in advance, we will have then debited bank for the income being received and credited what? Income received in advance. Then what do we have? We then have what? We then have an income received in advance liability of 15,000. What about the tax base? What is the tax base for an income received in advance? The tax base of an income received in advance is the carrying amount less amount not taxable in future. So now let's talk. Will SARS have taxed this amount? Remembering that they taxed the amount on earlier of invoice or what? And receipt. Did we receive the money? Yes, it is the income received in advance. So that means SARS taxed it. Will they tax us again when we actually undertake the work? No, there are no future tax implication. So the amount not taxed is actually 15,000 because they are going to tax 0. So that means 15,000 is not taxed. So as a result, it is 15,000 minus 15,000, resulting in a tax base of a liability being 0. So nothing will be taxed in future, meaning that what? 15,000 will not be taxed because nothing will be taxed. So very strange language there. So as a result, we have carrying amount and tax base that looks like this. Then the last one, we have the accrued rental. So I'm sure you are seeing where we are heading with this. So how will you then process this? You will debit the rental expense because you have received your rental bill. Sorry, the rental expense, and you will credit what? You will credit accrued rental. So now, is this related to income or cost? This is related to cost, and that is 20,000. So if it is related to cost, which definition do we apply? We apply the one that says the carrying amount less what? Less future deductions. What are the future deductions? We go back. Will SARS have given us a deduction when we receive the invoice? What is their principle? Earlier of invoice and payment. So did we receive the invoice? Yes, that's how we knew we owe so much rent. As a result, what do we have? We have no future deduction. So as a result, we have a tax base of what? Of 20,000. Meaning that I've got the carrying amount of 20 and a tax base of 20. So that is how that works. That is how that works. So I hope you are seeing how we apply these definitions. Then the next slide is very important. So let's go back to our slide. Excuse me. Then we introduce a concept, the concept of temporary differences. Then what are temporary differences? So firstly, the word difference highlights to us that we are comparing two things. So what two things are we comparing? We are comparing the carrying amount of an asset or carrying amount of a liability. With what? With the tax base of that asset or that liability. If there is a difference between them, in other words, there is a rand number, we are saying that is called a temporary difference. But what makes a temporary difference to be different from any other difference? Okay, too many differences. The issue with it is that it arises due to timing effects. It arises due to timing differences. In other words, it's not that SARS will not give you the deduction. It is just they've either given it to you already or they will just give it to you in the future. So it's not that I'm not going to get it. It is just a difference in the timing. Like for income received in advance, we saw them taxing the amount when? Taxing the amount now. And we are only going to include the income later on. So that's why there was a difference. So the difference arises because the timing of including an amount for income tax purposes, it is different from the time of including it in income for tax, for accounting purposes. If the two are aligned, we will not expect there to be a temporary difference. Then there are two types of temporary differences. There are those that we call taxable temporary differences, and there are those that we call deductible temporary differences. In part 1 of income taxes, we will only be looking at taxable temporary differences. So what are taxable temporary differences? These are amounts or differences that will result in future there being an amount that will need to be taxed for tax purposes. So there will be an amount that will be taxed for tax purposes, and it will not be there for accounting purposes. So let's clarify that. In future, I'm saying that if I expect there to be future accounting profit of 100,000, then if I've got a taxable temporary difference of 20, then I will expect taxable income in future periods to be 120, because there is an amount that will be taxed for tax purposes that will not be taxed for accounting purposes. We call that difference a taxable temporary difference. So let's make another example. In future, I expect there to be 1 million of profit before tax. But for taxable income, on the same set of numbers, I believe that SARS will say that I owe them tax on 1.2 million. So there is a difference from what SARS, or what I believe SARS will say, of 1.2 and what I plan or I believe IFRS will say of 1 million. That difference represents an additional amount from SARS side, and that amount will result in me paying more tax. So that difference, we call it a taxable temporary difference. And because I'm expecting to pay more tax, a taxable temporary difference gives rise to what? It gives rise to future tax liability, which means that we are deferring some tax into the future. So now, if we go back to our examples, here, we will then see that here there was no temporary difference. Here there was no temporary difference. Here there was a temporary difference because there is a difference between what accounting is saying as well as what tax is saying. Okay, so that is what? That is a good start. Then let us do what? Let us then look at the next example to entrench these principles. CA Limited generated a profit before tax of 800,000 for the year ended 31 December 2020. The company expects to generate a profit before tax of 1.2 million in the foreseeable future. This amount is after taking into consideration the annual depreciation expense. CA Limited owns a machine. This machine was purchased on 1 Jan 2020 at an amount of 900,000. The useful life of it, though, is 600,000. SARS allow wear and tax deduction on the cost based on the following: 40% in first year and 20% for each successive year. So what is the deferred tax balance in 2020? Opening and closing. So now, remember, we have now established that deferred tax arises on what? Arises when there is a temporary difference. So now we are required to determine what is the carrying amount of this asset. So we will then say that the cost of the asset, how much is it? It is 900,000, okay? And then we have depreciation over a 6-year period. We have depreciation over a 6-year period. And that means at the end of the year, the carrying amount of this asset, it is what? So let us do this. So the carrying amount of the asset at 1/1/2020, there was no asset, so that's 0. Then at the end, so that is at 31/12/2020. All right, now how will the tax base look like? So the tax base, we are now saying tax base then what do we have? We have the cost being the same, and we now have wear and tear allowances. And then they said it is what? It is 40% of the cost in year 1. So I expect then this to be what? To be 40%. So that is where we are sitting. So that is where we are sitting. All right? If I come at the end of the year and I ask you, what is the future depreciation expected on this asset over its useful life? Do you agree that future depreciation is equals to 750? And if I ask you what is the future wear and tear allowances, I will expect you to tell me that in future, the wear and tear allowances are how much? 540. So this is critical because it's going to help you understand deferred tax. So now, what do we have? at the beginning of the year, so we are now doing what? The temporary difference. So at the beginning of the year, there was no asset, so that means the difference between these two is just 0. Then at the end of the year, we are seeing that there is a difference. And the difference, does it represent a taxable or a deductible temporary difference? So this is tough, right? This is tough. So assuming that we have what? We have 1 million in revenue in future. If my future depreciation is 750, what will that mean? So if I then say in future there are revenues of 1 million and my expected depreciation is 750, then, or actually they've given us. So in future, they expect to have 1.2 income. And I expect to have what? I expect in both cases. So if we think about it, let's do this. So they said profit before tax. In future, it's 1.2. And we know profit before tax. What does it do? It has included depreciation. So we will say that, but for SARS, there is no depreciation. So they will want to add back this depreciation. And they will want to do what? They will want to deduct the wear and tear. So they will then deduct the wear and tear. And as a result, what do we have? We have 1,410. So what are we saying? We are saying that the taxable income is expected to be 1,410, whereas the profit before tax is expected to be 1.2. So do you expect there to be a higher tax for taxable income than for profit? What is your answer? Do you expect there to be a higher tax on 1.4 than they will be on 1.2? So this is not as tough as it was. So the obvious answer here is that yes, there will be a higher tax expense based on taxable income. So as a result, because we are expecting taxes to be higher in future based on taxable income, this means that this is a taxable temporary difference. This is a taxable temporary difference because we expect what? More taxes in the future. And to get to deferred tax, how much taxes will those be? It will be 5,880. And that will be what? That will be our deferred tax liability. Okay. And then this number of 288 is interesting. So, but let's just see. What are they saying? They are saying that what is the current tax expense and what is the expected tax expense? Remember, the tax expense is based on taxable income. It is based on taxable income. So under the current year, we will then have profit before tax. We will then have profits before tax of how much? Of 800,000. And we're going to add back the depreciation of 150. And we're going to deduct wear and tear of 360. So the reason we add back is because we don't want depreciation, because SARS does not have depreciation. So they are saying, I don't want that, add that back, and I'll give you wear and tear. So we notice that in the current year, the taxable income is 590. Then in the future, we had already determined it, and we are seeing it being what? As 1410. What is the tax expense in both instances? The tax expense, it is what? It is 165,200 and 394,800. Interesting. So that is what was asked of us. So this is expected in the future. Right? Then now, what is the current tax expense? What is the tax expense for 2020 and future years? So this is that. Okay, I mixed them up. So this was that. Then to clarify what we're looking for in part B, we are saying that what is the current and expected tax? So what we expected, so before tax. So this is what we expected. So we expected to pay what? 224. And so if we then do that, we expected to pay tax of 224 and 366. So maybe let me just highlight that for part B, we were looking for accounting. So this is part B. So this is accounting tax. Maybe it should be clear. I don't think it was as clear as I wanted to be. Then this is SARS tax. Let's just make it follow each other properly. Okay, so we've got accounting tax and we've got what? We've got SARS tax. So this is interesting. So these numbers are not the same. So now, how do we make these numbers to be the same? What is the tax expense? So what is the tax expense? So we will get to learn this at a later point. But the tax expense, it is equal to the current tax expense. It is equal to the current tax expense. Plus what? Plus, oh, you were, I was wondering where you were. So it is equal to the current tax expense plus deferred tax expense. So what is the deferred tax expense? The deferred tax expense, we saw it up there as 58. And when we add it here, what do we see? We see the marvel that is what? That is accounting. So we are saying the tax expense is equals to current tax expense plus the deferred tax expense. And when we add the current, which is based on taxable income, based on SARS, so this is SARS tax. So based on SARS tax, what do we notice? We notice that that tax is 165. But for accounting was expecting 224 based on the profit generated. Therefore, when we understand what is the amount that is disclosed to the users, we come to understand that the amount disclosed to the user is the tax expense. And the tax expense is calculated as the current tax expense plus the deferred tax expense, which then gives us what? 224. So what we are also seeing, we are seeing that deferred tax helps us to smooth the tax expense between what SARS is charging us and what we expect to see. So if you then look at part D, which says, provide the journal entries to account for the tax expense in the current year. So what will then happen is that we will then have what? We will then say we are debiting the tax expense because it's a P&L item. And it will be debited with current tax expense being the amount of the current tax liability, being the amount owed to SARS of 165. And then we will say debit tax expense, P&L, and we'll credit the deferred tax liability that we recognized or that we accounted for above there. So if we then think about it, the deferred tax liability gives rise to a tax expense. The current tax liability gives rise to a tax expense. The two tax expenses added for the year, they give rise to the total tax expense for the year. Does that make sense? Does that make sense? So that will be what you need to ask now. If you are saying you're a bit lost, please just go back and make sure you understand what we're doing. But a quick recap, we started out with what? We started out with the calculation of the carrying amount and the tax base. We saw that it resulted in a difference of 210. And then we determined that it was taxable based on what we expect in the future for accounting and for tax purposes. Another way is to then assume that the revenues in future is just 1 million. If it is 1 million and I deduct depreciation, I'm left with 250. On the other side, if I deduct wear and tear, I'm left with 460. So I don't need any specific amount here. The answer will always be that this will result in amounts that will be taxed in future that will not be taxed for accounting purposes. And that's how we get to what? To taxable amounts. Then we determined that the expected tax expense is what? It is, I think I'm complicating this. Let me just do this. So this SARS is equals to current tax. I don't want to confuse you with the terminology. And then this is what we are calling accounting tax. And I'm calling it expected tax, because that's what is expected by who? By the shareholders. If you tell me that you've got 800,000, I expect that the tax is what? Is 224. Then we are now saying that the tax expense for the year, though, it is the sum of the two amounts. So we sum up the current tax. We sum up the what? We sum up the current tax. And what do we have? We then have 224. And we process the journal entries in this manner right here. So this is much cleaner. And this is what I wanted to achieve. So I'll share this Excel with you so that you can follow. So these are how we are thinking about it. So let's just then refine our thinking. If you then consider the two pictures here, so this picture I've provided you to give context. So you will then see that, hold on, if I then look at the difference here of these two numbers here, and the difference of this, what is that? So I will then say the sum of 150 and 360, 210. Then the sum of 750 minus 540, 210. So I see an interesting trend here, or an interesting picture. It seems to suggest that this 210, which I saw which I saw above them, where are my shapes? Yes. So this 210 and this 210, are they coincidentally the same, or is that how deferred tax work? So these numbers will then be what? Are coincidentally the same. Oh, okay. So I'm clarifying that you should not expect this to be what? You should not be expecting this to be the same. But why were they same, and why would they be different? This, we call it the movement in taxable, in temporary difference. What do we mean by the movement? That we have opening temporary difference of 0, and we compare with what? Closing temporary difference of 210. So this difference right here, it gives rise to what? Gives rise to the movement in temporary difference. So it gives rise to a movement called temporary difference. So that means here we expect to see a movement. But because here there was an opening of 0 and a closing of 0, of 210, it was coincidental that they were what? That they were the same. So that is one important note to make. But before we also move, we notice that here in the current year, this movement actually was deducted. Is that how it works? So the movement, if it is what? If it is taxable, it means that we are removing it from current year. We remove from current year and we defer it into what? Defer into future years. So we remove in the current year from current year, and when we do that, we deduct. And in the future years, we add. But in most cases, we are focused on just doing the accounting for the current year. But I just wanted you to see how it works. So it's a timing difference. At the end of the day, the difference will add up to what? The difference add up to 0. Because in one year, it's a subtraction, in the other, it's a positive. So that is what we call a temporary difference. So if it is taxable, in future, it increases profit before tax, whereas in the current year, it reduces profit before tax. So that is what we are seeing. In future, it is called taxable because it adds to current tax and the amount becomes taxable. Whereas on the other side, it is deducted. So that is how we then think about it. So then can someone just then put the movement instead of this? That is what they want. So this picture right here will then be what? Will then be, and this is what we call the statement of financial position method. So here we will then have movement in taxable temporary difference. And we'll then have this movement subtracting. And that is how that looks like. So that is how that looks like. So we will just have movement. So this, we were just doing it because we were explaining the concept. But you will see, they will say that they don't want you to do this. You are required to do what? You are required to do this down here. Okay. Sure. Let's then see. So yes, we've addressed, I think I've spoken about all the critical elements with you, and that concludes our discussion on this. A simple example, but very fundamental. So we're going to be building on this principle throughout our session. Okay.